Welcome to Building the Future, hosted by Kevin Horick. With millions of listeners a month, Building the Future has quickly become one of the fastest rising programs, with a focus on interviewing startups, entrepreneurs, investors, CEOs, and more. The radio and TV show airs in 15 markets across the globe, including Silicon Valley. For full showtimes, past episodes, or to sponsor the show, please visit buildingthefutureshow.com.
Welcome back to the show. Today we have Phil Nadel. He's the founding and managing director at Forefront Venture Partners. Phil, welcome to the show.
Thanks for having me, Kevin.
Yeah, I'm very excited to have you on the show. I think what you guys are doing at Forefront Venture Partners is really innovative and cool. But maybe before we get into that, let's get to know you a little bit better and start off with where you grew up.
Sure. I grew up primarily in South Florida.
Okay.
I was born in New York, but moved to South Florida as a kid, and went to high school here, and grew up here in South Florida.
Very cool.
And I'm back here now. That's where I live.
Very cool. So you went to university. What did you take and why?
Yeah, I went to. There was only one school I wanted to go to. I only applied to one college,
Okay.
The Wharton School at the University of Pennsylvania,
Okay.
my
Why
alma
was that?
mater. Because it is and was the premier business school in the country.
Got you.
And that I knew that's where I wanted to go, and I knew I wanted to go into business. So I figured, if I want to go into business, I should probably try to go to the best business school I can get into. And so fortunately, I did get in. I don't think I would today, but I did then.
Why do you say that?
And because they've gotten much, much tougher.
Okay.
And but I did get in and had a great experience there in Philadelphia, and afterwards moved back to South Florida, as I said, where it's nice and warm. But had a great experience. I studied finance, and I studied entrepreneurial management.
Interesting. Okay. So you get out of school, you move back to Florida. Walk me through your career, maybe some career highlights along the way, up until kind of what you're doing now with Forefront Venture Partners.
Sure. So from the moment I graduated from college, I became an entrepreneur. I've never worked for anyone else.
Nice.
I've only worked for myself, and I started a financial services company, really doing asset-based lending.
Okay.
And actually, that's one of the companies that I still have today. So
Nice.
We've been doing that a long time. And we do asset-based lending of all kinds. I'm not involved in the day-to-day operations anymore, but I do still own it. I also got involved in the publishing space early on, and that company sort of morphed over time. We were doing a lot of publishing of business-related newsletters, and morphed into direct marketing of not just information products, but physical, tangible goods. And that grew very quickly. This was sort of the early 90s. Okay. And it grew, pre-internet. Sure. It grew very quickly and had a really nice exit. Nice. And started a couple other financial services companies, including a factoring company, commercial factoring company, which I also sold for a reasonable amount. And then I've gone on to start other companies as well in the publishing space, online marketing, loyalty and incentive reward space online. And some of them I've exited, some have been modest successes, and some we closed early. Gotcha. So it runs the gamut. But after my first big exit, what I found was that family and friends who were interested in starting businesses were approaching me not just for advice, but for an investment. They wanted me to invest in the company. And so I did some of that early on. I invested in companies started by family members, by friends, by people I knew. Interesting. And it was a learning experience, right? And so there are definitely pros and cons to investing in businesses owned by family members.
Yeah,
or
I can
friends.
imagine.
Yeah, it can lead to problems. Fortunately, everything worked out fine, and none of them led to any kind of big problems. But I had some successes and some failures, but all along the way, I was learning a lot and about investing in other people's companies and not being an active participant in the day-to-day operations of a company, but merely being an advisor and an investor. And I sort of like the idea of leveraging other people's intelligence, their resourcefulness, their initiative, their ambition. And I felt like instead of starting more businesses myself, where I can only do so much,
Sure.
if I invest in and advise other people, I'm really leveraging off of their talents.
Interesting.
And so I started to invest in startups, in early stage companies, more as a full-time endeavor.
Gotcha.
And then it really became my full-time job. And so, I've invested now in more than 100 companies.
Wow.
And in a variety of industries, and we can talk further about that. But
Yeah, sure.
but that's sort of how I got from, that's sort of the general path from post-college, graduating from college, starting businesses, exiting businesses, and getting the idea that, hey, it might be fun to invest in other people's businesses as well.
Sure. So how did Forefront Venture Partners come to be, and what exactly do you guys invest in?
So Forefront Venture Partners is one of the largest and most active syndicates on AngelList.
Okay. What does that mean for people that don't know?
Yeah, let me explain that.
Sure.
So AngelList is an online platform that allows individual angel investors to invest in startups. And they make it really simple. They do all the heavy lifting,
Okay.
and they make it easy for angel investors to invest as little as $1,000, $2,000
Nice.
in a company. And so that online platform, AngelList, has become very, very popular. Well, about 5 or 6 years ago, they launched a feature on the platform called syndicates.
Okay.
And the idea was that they would take some notable investors who would sort of be a lead investor in a startup,
Interesting.
and they would allow other angel investors to invest alongside with them. And so I became one of those lead investors. And so what we committed to at that time was every company that I invest in from then on, I would share with our syndicate group.
Got
So
you.
folks who join our syndicate who want to invest small amounts get the benefits of having us source deals, do the due diligence, negotiate terms, do all the legal work, and then continue to advise and follow the companies. And they get to invest alongside us at the same terms that we invest in.
Interesting.
So instead of trying to find deals themselves and negotiate deals with these companies when they only want to invest maybe $5,000 or $10,000 in each company, it makes much more sense for them to join a group
Right.
who want to invest. And so that way we have more leverage as a group as opposed to just an individual investor approaching a startup. Does that make sense?
Yeah, that totally makes sense. And it seems to me, I've had a few firms that do investment over the years on the show. It seems like you guys are one of the very few that are actually doing that, right? I know there's others, but it seems almost like a bit of a competitive advantage for you guys to actually do it that way. Is that fair to say?
Well, I think that the competitive advantage that we have comes down to the fact that we do this exclusively.
Gotcha.
So a lot of the syndicate leads on AngelList are like, for instance, a venture capital fund who may occasionally syndicate one of their deals via their AngelList syndicate. Or it could be, this is also common, an entrepreneur who's done well and has a nice network and wants to invest with some of his peers and associates going forward. So they'll put together a small syndicate and invest in deals once in a while. We view it differently. This is our exclusive business. were full-time, devoted to unearthing, sourcing great deals, great companies to invest in, and making them available to our syndicate investors. And then beyond that, we're absolutely committed to providing frequent, regular communications from the companies. And this, I think, is a big differentiator for us, and we hear this all the time from our syndicate investors, and that is other companies they invest in that aren't through our Forefront syndicate, they very rarely hear from the companies. They don't get regular updates.
Sure.
They don't get reports. They don't hear from the companies, and they hate it. They one of the main reasons why individual angel investors invest in companies is that they want to stay up to date on the company, and they want to help wherever they can. If there's an opportunity for them to assist the company and help them grow, they want to do that. And part of the benefit of a company keeping its investors updated is that they get to leverage all the experience and knowledge and connections of their investors. And so that's a real benefit. And so our companies that we invest in commit to us in writing in advance to provide regular updates to our investors. And that's a huge differentiator for us because very, very few other syndicates are committed to that, none that I know of.
Interesting. Yeah, in my experience, I would agree with that as well, right? That's interesting. So what types of companies or verticals do you guys like to invest in, or does it really matter?
So one of our investment theses is that we want to help our syndicate members build a diversified portfolio, as well as building a diversified portfolio for ourselves.
Sure.
So we're intentionally not focused on any one industry or sector. We try to remain industry agnostic.
Okay.
But there are a few sort of caveats to that. And I would say number one is that we focus on post-revenue companies only. Okay. So we only invest in companies that are already generating at least some revenue. It doesn't have to be significant. Okay. But we want that early indication of product market fit. We want that early indication that some third party is willing to write a check for the product or service being sold.
Gotcha.
So that's an important threshold for us. And the other thing is that we don't invest in really capital-intensive businesses.
Okay.
So if we know that a company is, like a biotech company that's going to need hundreds of millions of dollars for research and development, that's something we're not going to invest in. That's
Gotcha.
Not the kind of journey that we're looking for. Same thing for companies that are focused on building out via brick and mortar. If they want to build, brick and mortar stores or restaurants, that can be capital intensive and something we're likely to shy away from.
Gotcha.
So we do invest in B2C companies and B2B companies. We invest in some hardware companies. We do a lot of SaaS companies. So a real variety. Again, it's about building a diversified portfolio, but I did mention a couple of areas that we kind of shy away from.
Sure. So I'm curious to get your thoughts, because I've heard from people that sometimes they like being able to invest in a handful of different spaces, like you just mentioned, or they don't like investing in companies that they haven't been in that industry. So why do you guys broadly invest, and why do you think that makes a lot of sense? Because some people shy away from those industries that they've never worked in before.
That's a really insightful question. And I appreciate you asking it, because there are two schools of thought on that for angel investors, right? One is invest in what you know, right? So if you started an engineering company and you sold it and you did well and you want to invest, stick with businesses that are in engineering or something similar to what you were doing, and there's a lot of sense to that. But there's also the diversified portfolio approach, and that's the approach that we take, which is to say that a sector can have a lot of ups and downs and can be affected to a greater degree than a broad diversified portfolio.
Sure.
So you can really get hit in terms of valuations over time in a narrow sector. Plus, there just aren't that many opportunities to source. Depending on the niche,
Right.
depending on the industry, there may not be enough deals. So you end up with a concentration of your investment in just a handful of companies, and I don't think that's smart. If you look at the historical venture capital returns, they're built off of a large number of investments. So
Okay.
you need to have a large number. When I say large, I mean generally considered to be greater than 20.
Okay.
But even greater than 10 investments is still, you're getting there. But if your investments are concentrated in 3, 4, 5 companies, I think, any time one of them goes out of business, that really is going to affect your overall portfolio returns. So knowing that 70% or so of startups that investors invest in will eventually go out of business, you need to make sure you have enough companies in your portfolio so that you can have some of those winners.
Sure.
And so back to your question. So we take the view that a portfolio approach across industries makes the most sense because it gives us opportunities to sort of source many more deals, quality deals, and not be focused just on one industry, and to leverage opportunities in other industries and take advantage of industries that may be new and growing.
Sure.
If you just end up relying on the industry or the area that you're comfortable with, then you really aren't taking advantage of new and upcoming technologies that are growing quickly. And I think that can be a mistake, and that can hurt your overall portfolio returns. So while I'm not saying that one approach is right and one is wrong, we take the approach that it's better to be diversified across industries, across a lot of different companies, than it is to be focused just on one niche.
Sure. Well, and I also think too, sometimes if you're in one industry, you just automatically work around the red tape, where if you come at it and you've never worked in that industry before, you can literally be, well, that doesn't really make sense. Why don't we just do it like this? And it could be something really simple sometimes. And that person or that founder that you invested in, like, I never thought of it like that because of this, this, and this. And you're just like, well, in other industries that we've invested in, you would just do it like that, right? Is that fair to say, or have you experienced that?
Yeah, I think having those outside perspectives, perspectives from outside that little insular industry, can be very, very helpful, right? So You're right. I mean, as more generalists, we get to apply successful techniques from lots of different businesses to our portfolio companies. And there are also, I have to say, there are also great opportunities for synergies between our portfolio companies.
Yeah,
so
interesting.
When you focus on one industry, one thing is you have to be careful of investing in competitors, in conflicts of interest, and we try to avoid that. So, when you're investing just in one industry, you may invest in one company that does something, and then you have to avoid, or you'd want to avoid, their competitors. So that further restricts your ability to deploy funds. But we invest across industries, and so we don't really have that problem. But yes, we take techniques that we see portfolio companies using successfully, and we'll share them with other portfolio companies, and that works very, very well. And also, as I said, there are great opportunities for these synergies for companies to work together within our portfolio, and we've done a lot of that.
Yeah, that makes a lot of sense. And then, right, you have just people that invested even $1,000 could give some sort of really good perspective, right? So that's quite interesting how you got your angle on it.
Yeah, I'm glad you brought that up, because we see that time and time again, that our portfolio companies, when they issue their regular updates,
Yeah.
they'll usually include some information about like requests for help. So, can anyone introduce me to this potential client? Can anyone recommend some great product developers or engineers or a great salesperson? Whatever it may be, our syndicate members inevitably will have suggestions for help. They'll reach out to the CEO of the company and say, "Yeah, I can help. Here's someone I want you to connect with," or "Here's an idea that we employed in my previous company that might work for you. Here's a recommendation of to outsource to this company." They get all kinds of input. It's really a great model. And plus, from an investor standpoint, all of our syndicate members go into one entity, so they end up being only one entity on the company's cap table. So even though they have like the collective wisdom and connections of 80 or 90 or 100 people, it's only one entity on their cap table, which a lot of companies are worried about. They don't want to have so many individual investors.
Yeah, that makes a lot of sense. That's quite interesting. So when people are looking to pitch you guys for investment, are there certain things you guys look for and are kind of oh man, that's a total no-no? Like, walk us through that, how you guys decide who to invest in and who not to invest in.
Sure. Well, like most early stage investors, the first thing is the people, right? Mm-hmm. We want to be very, very excited about the founding team.
Okay.
And they have to really show us that they have the potential to grow this company. They have the passion for whatever product or service they're in, and that they know what they're doing. They have a clear vision for getting the company from where they are today to an enterprise scale company. Okay. It's not always going to happen, but they've got to have a clear vision, and that vision has to resonate with us. So that's number one. I mean, the company has to have, or the product has to have a large enough addressable market. Okay. So we can't invest in very small addressable markets because the company's not going to turn into a big company. Even if they get to 100% penetration in a certain market, if the market is very, very small, the company's not going to be an enterprise scale company. So that doesn't work for us. It needs to have scale potential. And so we certainly look for that. In terms of the stage that the company's at, I mentioned that we don't invest in pre-revenue companies or companies that haven't really shipped a product yet. And so that's important. Again, we want to see some indication of product market fit, that people are willing to pay for the product or service that they've come up with. So I think that's important. We look for founders who understand the market they're in. They understand the competitors, and they have a true differentiator, something that makes their product unique and helps them to stand out from the competition. And that may not be a forever differentiator, but it's got to be something that can get them in the door and differentiate from all the other companies out there. So I think that's another important point. There are lots of things that we look for, right? I mean, I'm just sort of scratching the surface, but that gives you a start. It's got to be something that's defensible or proprietary.
Sure.
That's yeah.
And you guys have a full thesis on a bunch of things that you guys look for on your website as well, and people can go check that out at forefrontvp.com/thesis. So.
Thanks for listening to Building the Future. This show is heard by more than 1 million people monthly in over 15 markets worldwide, including Silicon Valley. Kevin Horick's guests are leading business owners, successful entrepreneurs, and merchandisers worldwide. Now, your brand has an opportunity to tap into this dedicated and active group of business people who are looking for places to invest and the right opportunities to support. Find out how you can get involved at buildingthefutureshow.com.
I'm curious, though, is there anything that you see all the time that you wish you didn't see when people are pitching to you guys?
I think that it always surprises me. Well, a couple things always surprise me about pitches. One is that some founders think it's a good idea not to be transparent and not to be candid, and they're very coy. And I think that if you're trying to, if you're asking someone to invest their money in the company, you better lay your cards on the table and tell them everything, the good, the bad, the ugly. Every company has weaknesses. Every company has shortcomings. These are early stage companies. No one has every answer or has everything covered. That's expected. But share with us your thoughts on those areas of weakness and areas that need improvement.
Well, because you might be able to help, right? With
for sure.
You could say, oh, yeah, that's not really an issue at all. It might be to me, but if you're willing to invest in my company, whatever that is, and I have this weakness, you could be like, we can solve that, or we've solved that same problem, right? So, but if I didn't tell you, you would never know, or potentially never know.
That's for sure. But even if the company has an area of weakness, if they understand it and have a plan for making it turning it into a strength, then that's great. So tell us that you're weak on product engineering, but here's our plan for getting over that hump. Here's our plan for hiring and bringing on the right talent, or whatever the case may be. Our churn rate is too high right now, but here's our plan for reducing churn rate over the next 6 to 12 months, and here's how we're doing in getting there. So if you have a problem, tell me about it, and if you have a potential solution in mind, share that as well. But too many companies try to hide information, try to hide areas that they're concerned about, and just try to sugarcoat everything. So I think that's a turnoff for us. And the other thing that always sort of surprises me is we'll have introductory calls with companies sometimes, and I can't tell you how often the founders will not follow up with the information after the call that we've requested. So typically during a call, if we're interested in the company, we'll usually request some further information after the call.
Makes sense.
And so many founders just drop the ball and don't follow up.
Wow.
They won't send us the information, or they'll forget, or whatever it may be. And it just, to me, that's a real red flag, because if they're not going to follow up with potential investors, how are they going to be with potential customers?
Interesting.
And that's a signal for me that we better take a closer look here, because that concerns me. So those are some of the things that I'm always surprised about with pitches. And then you get some people who say they want you to sign a non-disclosure agreement, and they want you to jump through hoops before you share information. We have incredible deal flow, right? We see lots and lots of deals. We're not wanting for deals, and venture capitalists typically do not sign non-disclosure agreements and aren't going to jump through hoops to get information about a company. Make it easy. A lot of companies set up data rooms where you can just go online and view all the data, and that's super easy and a pleasure to deal with.
Interesting. Well, and tell me your thoughts on this, because I think ideas are worthless. It's the execution that's worth something. Is that fair to say, or do you agree with that?
I think it's the combination, right? So I agree with you that I think execution is more important.
Okay.
Ideas, I agree. Ideas without execution are worthless, right? Mm-hmm. But if you just have execution and you don't have a good product, a differentiated product, then you're sort of spinning your wheels.
Right.
You can go out and sell all day long. You could be the best salesperson in the world, but if you're selling a product that isn't special or different or doesn't solve a problem for a company or an individual, then you're not going to get anywhere.
Right.
Really. So I think companies need both.
Okay.
You need to have a good product so a good idea or product, and then you need to execute. You need to engineer, you need to sell, and you need to follow up. You need to retain your customers. All of those things. Yeah.
Okay. So I think I know the answer to the next question, but there seems to be a trend in the investment community that they almost don't care what the product is. They're just willing to invest in somebody and they'll and let them kind of figure it out. It sounds like you guys want at least a product idea and somebody that you really believe in. Is that fair to say?
Yes, but we fully understand that most successful companies have pivoted
Right.
or at least iterated during their early life cycle.
Got you.
So we don't fool ourselves in believing that the initial product that we're seeing today is necessarily going to be the ultimate product when the company exits,
Gotcha.
10 years down the road. So,
Well, it shouldn't be, right?
yeah, well, hopefully not. Hopefully they're growing and improving the product, but sometimes it's a dramatic pivot
Right.
where they get into something completely different. And I'd rather be investing in a really smart, scrappy, resourceful founding team who can make that kind of pivot
Gotcha.
and realize that the market is speaking to them and that their current product isn't filling a need or solving a problem and that they need to pivot. But if they're learning from those early errors and pivoting into something that is solving a problem that's in demand by customers, that's smart, and a smart founding team will make that kind of pivot. But you can have the greatest product if you don't have a great founding team. Then a competitor comes along and the founding team doesn't know how to react, and they don't adjust and iterate and grow the product, improve it over time, and then it's going to fade out. It's not going to be a long-term success.
No, it makes a lot of sense. And I think just the word pivot has such a negative connotation to it. And I think basically, in my opinion, you can tell me your thoughts, is basically every company that's stayed around for generations is constantly pivoting. Maybe not like huge all the time, but even take Amazon or Apple, or they pivot all the time. Not necessarily bad. I think we wouldn't have some of the things that we have today if these companies didn't do that. Do you agree with that? Or am I off?
I do. No, I think they evolve or die, right? You have to evolve, continue to evolve over time, or the company dies. You can't be stagnant. You have to constantly innovate, and as you said, it can be in small ways. It could be iterations. It doesn't have to be a major pivot, but you must continue to innovate and stay ahead of the competition, but also stay in front of your customers with new and exciting features that they want and need. And so, if you keep providing customers with solutions to their problems and with innovative ways to make their lives easier or make their companies more profitable or save them time, then you're going to be successful. But that's an ongoing process. It's not a one and done kind of thing.
Sure. So I'm curious to know, do you guys only invest in certain geographic regions, or how does that kind of work for you guys?
We invest primarily in the U.S., but we also invest in Canada, Israel, and a little bit of parts of Western Europe.
Okay.
But to be fair, 95% plus of our portfolio is in the U.S.
Okay.
And in terms of geographic preferences within the U.S., we don't have any.
Okay.
We are, geographically agnostic within the U.S. And it's interesting to note that valuations differ significantly across the country.
Interesting.
And we are really focused on getting the right valuation when we invest. And so, for that reason, while we do have a number of Silicon Valley located companies in our portfolio, we don't have as many as some other early stage investors because the valuations for those companies are typically much higher than the valuation would be if the company were located in the Midwest or somewhere else. So we really invest all over the country, and there are great companies coming out of all different areas.
Sure.
There are certainly more challenges in certain areas for companies that are just starting out in terms of recruiting talent and whatnot, but we take that into account, and also again look at valuation. So we invest all over the U.S.
Got you. So I'm curious, in your experience with all the companies that you guys have invested in, there seems to be a bit of a trend to hire more kind of remote people and maybe not make people move to Silicon Valley or other kind of hotbed startup parts of the country. Do you find that, or is that just kind of, stuff that you've read in the media? Because it seems like there's a ton of people that are really talented, like you mentioned, maybe in the Midwest or somewhere that's not necessarily like a Silicon Valley, but, and they don't want to move or can't move, but, these companies want that talent and they're willing to say, you know what, I don't care where you work, right? Have you experienced that, or what are your thoughts on that?
Yeah, I think that is one of the greatest things about our connected world that we live in today. For startups, it means that they're not limited to the talent pool that's in their backyard, right? They can outsource talent from all over the world, literally.
Okay. Sure.
And they can get great developers in India, and they can get great product people in Boston, and they can get people from all over the world, and they don't have to they don't require them to move physically. They can work part-time. They can specialize in whatever area it is that they do, and sometimes the startups not only will expand their the number of people available to them from just their backyard to the whole world, but also they'll get economies of scale because they'll get lower cost talent from other areas. So Silicon Valley companies are probably the easiest example. I mean, talent in Silicon Valley area is so expensive that a lot of the companies will outsource it to other parts of the U.S. or overseas and save a lot of money while also getting access to great talent.
Sure.
So it's not only difficult to hire in Silicon Valley, it's extremely competitive, and the salaries are high. So by looking outside your backyard, you really get to outsource to some great talent, but also to save money in some cases.
Sure. So I'm assuming the first few calls, unless somebody's kind of within a few hours of your guys' office, you do the first meetings with a potential investment over the phone or video calling. But at some point, do they have to come down and meet you guys in person, or will you fly to them, or how does that kind of work?
Yeah, it's not. We don't require that companies come to us in person.
Okay.
Sometimes we'll go to them. Sometimes we'll meet in a common place. If we both happen to be in New York or in San Francisco, we'll meet there. Whatever that may be. But we will invest in companies without ever meeting the founders in person. We'll do video conferencing. We'll do phone calls, and we do a lot of due diligence. We do a lot of due diligence. So we do reference checks on the founders. We do customer reference checks. And we speak to other investors, and we check them out thoroughly, even if it's a case where we don't meet them in person.
Got you. So the due diligence process is probably different depending on how much money and what type of business, but is there a typical kind of period? Is it weeks? Is it a few months? How long does it typically take? Or maybe a range that's roughly how long it takes with you guys?
Sure. The amount of time it takes for our due diligence is somewhat dependent on the company and how prepared they are, how forthcoming they are with their information. So, as I mentioned earlier, if the company has like a data room set up online where they have all of the documents that investors typically want to see, then our due diligence might be as little as a couple weeks,
Sure.
or even shorter if need be. But if they aren't prepared for the due diligence process, and we have to request documents, and then they need time to prepare them,
Right.
or gather the information, then it can be a much longer process. It can take, who knows how long. It depends on how long they take to get back to us. But our time, the time that we require to review the documents that are necessary, can be as little as a week or two. I mean,
Okay.
we can, if we're focused on a deal and really trying to get it done before a certain deadline, and we'll get customer calls done, reference checks done. We'll check out. We'll do all the due diligence. We'll do everything with a lot of focus. And also, I have to say that part of it, of the timeline required, is dependent on other investors that are in the deal,
Right.
and because sometimes we can leverage off of other investors' due diligence if they've done a professional job with it. If they're, especially, we're talking about institutional VC funds. I'm not
Right.
talking about angel investors. But if there's a lead investor who's an institutional venture capital fund, we can often leverage off of some of their due diligence as well.
Makes total sense. So I'm curious then, is there any trends or industries that kind of excite you as an investor that maybe you'd even like to invest, more into, or it doesn't really matter?
We try to remain very open-minded and open to a lot of different opportunities. So there are certainly industries that are growing faster than others and are more exciting, and there are technologies that are being deployed across industries.
Yeah,
so like artificial intelligence or machine learning as a component of artificial intelligence is an example where a lot of companies are finding really smart uses for artificial intelligence that are helping them to become more efficient, to become differentiated, to scale faster. And there are a lot of opportunities there across industries for companies who are deploying some of these new technologies like artificial intelligence. So I think, the same thing is true for some of the blockchain technologies that are being applied to various industries. I think that, there are lots of opportunities there. We have to be very careful to avoid companies that are just trying to use buzzwords or just trying to say that they're using artificial intelligence or blockchain or whatever, but really don't have a good use case for it. There has to be a really smart use case for those technologies and a way that they're utilizing it for their advantage, and not just so they can say to investors that we're an artificial intelligence company.
Yeah, no, that makes sense. And you guys probably get that quite a bit, right? That the people just jump from bandwagon to bandwagon trying to say they're doing something in this space. But if you look into it a bit deeper, you're like, well, you're kind of not really, right?
Yeah.
Interesting.
I mean, look, if you're a manufacturer of dog food,
Sure.
you probably don't need to say you're an AI-focused company,
Sure.
right? You don't
Yeah.
need a lot of artificial intelligence to create dog food.
Yeah.
So just, focus on making the best product, the best dog food you can, and don't worry about the artificial intelligence. So it has to be applied to the right kinds of businesses who can really benefit from it. So we have to keep our radar up for that kind of thing. But there are certainly a lot of exciting new technologies that will help businesses across the board to grow and to scale even quicker.
No, makes total sense. So I know you mentioned you guys invest once people start making a bit of money. It doesn't have to be a ton. But in your personal opinion, at what point in a company should people actually look for investment? Because some people say sometimes it's still a napkin idea. Some people say you need X amount of dollars. But what's your kind of opinion? Like, do they need, I know you mentioned like they need a little bit of money for you guys, but what do you think is kind of an ideal spot to raise money? Or does it really, really depend on kind of the industry and the person and where they want to take this thing?
Yeah, so all investors sort of have their own risk tolerance
Yeah.
and where they want to be. What we have seen for us is that the the risk reward ratio is best at the early stage once it's a company's post revenue.
Okay.
So in other words, you're paying a little bit more in terms of valuation for a company that has a little bit of revenue versus one that's an idea.
Right.
You're paying a little bit more in terms of valuation, but the de-risking that you're doing is so significant that in our view, it's really well worth it. You're reducing risk so dramatically, and you're only sometimes increasing the valuation slightly.
Okay.
So that kind of inflection point for us is really the sweet spot of where we like to invest. So before a company has truly started to scale, they've identified some scalable marketing and sales channels, right? They're experimenting. They've said, okay, we see that if we sell the product via this channel or that channel, it works, and it works at a reasonable customer acquisition cost. All we need now is fuel to pour on the fire. We need capital so that we can scale out this customer acquisition machine that we've built.
Okay.
And that's the place where we want to invest, where we're not necessarily at that point where they're reinventing the wheel. They've come up with a great idea. They've developed some ideas, some experiments around customer acquisition, and they're starting to get to a good customer acquisition cost. And now they just need more money to exploit those. And that's really the point where we want to invest.
Makes sense. I'm curious to know your thoughts on this as well. Do you find it's better or easier for people to either found a company by themselves or have a co-founder or many co-founders? I'm always curious to get people's thoughts on that, because I've seen obviously both work, and people have seen that. But what do you think is easier? Because I think I've heard from founders sometimes that if they're just a single founder, they find sometimes people don't actually tell them the truth because they're not like a co-founder, right? Where if you have a co-founder, you can kind of bounce ideas off people and they can kind of say, that doesn't make any sense. What's your experience with that?
So I think that let's look at the statistics.
Okay.
The statistics in early stage investing in venture capital space will tell you that disproportionately companies with a small founding team, like 2 or 3 founders, are more successful than those with either a single founder or a large group of founders,
Gotcha.
like 5 or more.
Okay.
So 2 or 3 to us is the optimal kind of number.
Gotcha.
And look, I mean, other than you, Kevin, not everyone is good at everything. Sure. I mean, maybe you are. I know you are, but everyone else is not.
Doubt it.
So, like, you take a successful engineer, for example, a really smart engineer. They may not be good at sales. You take a great salesman, they may not know anything about engineering.
Or enjoy it, right?
Or enjoy it, exactly.
Yeah.
And these are different types of personalities, different types of people. And I think, most good companies, successful companies, are going to have founders who are good at across a few disciplines.
Sure.
You're going to have the technical product guy. You're going to have, the person who focuses on sales and marketing. As you grow, you need to add people, of course, to this. But the founders should cover the primary disciplines. And I think it's very unusual for one person to be good at enough of that to really make it work. And if in those cases, we hope that they would have a plan for bringing on really good talent earlier than a 2 or 3 person founding team would necessarily need to do. So I think that it can work. Certainly it can work with a founder or even with a group of 5 founders. But the sweet spot, I think, historically in this business has been like sort of the 2 or 3 founding team, 2 or 3 member founding team, and that's what we like to see also. But we certainly do invest in solo founders as well.
Very cool. So we're almost at the end of the show, but I do want to have you mention, maybe do you want to highlight a couple of companies? You guys have had some exits, just doing some research before you and I kind of recorded. I've actually had a couple of the guys you've invested in on the show in the past, so that's kind of cool for me, selfishly. But do you maybe want to mention a few companies that you guys have invested in and talk about them quickly?
Sure. We're so proud of our portfolio. We've invested in such great people and great companies that it's a pleasure to talk about it. And we've already had a bunch of exits, so we're really happy about that. Some of them came much faster than we would have expected.
That's awesome.
So yeah, I can mention a couple of companies. I hate to highlight too many because it's like picking a favorite child. So I don't. But for example, we invested in a company called Grove Collaborative.
Okay.
Grove makes non-toxic products, cleaning products, and home products for your home. So detergents and soaps and things that are completely non-toxic and safe for your family. And when we invested just a couple of years ago, we invested at a $12 million valuation. Wow. Their last funding round was at a $255 million valuation.
Wow.
So they've grown tremendously. Sure. Huge success. We invested in a company called Wanderoo.
Okay.
Wanderoo is like the Expedia for ground transportation.
Oh, interesting.
A lot of people don't realize that more people travel on buses each year than travel on airplanes.
Oh, I didn't know that.
And yeah, and there are lots of different bus lines, and they're all confusing, and their websites stink. And so there's no easy way to book ground transportation, but Wanderoo has made it much easier. You can book any kind of bus trip in the U.S. and many, many other countries through Wanderoo, and they service hundreds of different carriers.
Very cool.
Also have grown like a weed. I mean, just grown really, really quickly. So those are a couple of examples. Our most recent investment was a company called Data Assembly, which provides major CPG brands, brand companies, and also retailers with real-time pricing data. Oh. So companies have been in the dark about what retailers are selling their products for on the shelves. Like if you're Pepsi, for example, who's one of their customers, if you're Pepsi, you don't know what Kroger is selling the product for, and you don't know in each individual local store what they're selling it for. There are huge variances.
Sure.
And so this company provides Pepsi with real-time data across every single store of what their product's being sold for. And likewise, if you're Kroger, you don't know what Walmart is selling Pepsi for, and you want to be competitive. And so now they can get that data. And this is the only company that does it. It's very exciting. We're thrilled to be a part of Data Assembly. So these are just a few examples of the types of companies that we've invested in. Our portfolio is 48 companies so far. And your listeners who are interested in investing can invest alongside of us without any obligation. In other words, they can just join the syndicate, and if they're interested in the deals, they can invest, and if they're not interested, they can pass. There's never any obligation.
That's very cool. But we're out of time. So do you want to close the show with mentioning where people can get more information about you guys and all the stuff we talked about today?
Sure. I mean, our website, as you mentioned, is forefrontvp.com. So it's just FORE, forefrontvp.com. And they can learn more about us there. Or if they're on AngelList, they can go on angel.co, which is AngelList's website, angel.co. And they can search for Forefront Venture Partners there. And they can learn about us there either way.
Perfect. Well, I really appreciate you taking the time out of your day to be on the show, and I look forward to keeping in touch with you, and have a good rest of your day.
Thanks so much, Kevin. It's been my pleasure.
Thank you. Okay, bye.
Thanks for listening. Please visit our website at buildingthefutureshow.com to join the free community, sign up for our newsletter, or to sponsor the show. The music is done by Electric Mantra. You can check him out at electricmantra.com and keep building the future.